Welcome. I'm Bob Kennedy, the director of the Davidson Institute, and I'm here today with Willy Foote, who's the CEO and founder of Root Capital, a very interesting financial organization that works on agricultural development in developing countries. So welcome, Willy.
Thank you.
So can you just describe what Root does? I think it's an interesting organization, and just introduce it to our viewers.
So I think at the highest level, we are using loans and financial training to try to connect isolated farmers in Africa, Latin America to global markets, to more inclusive markets. Mm-hmm. So our mission is to grow rural prosperity by investing in agricultural businesses that build sustainable livelihoods in Africa and Latin America. So it's a social investment fund that I founded about 10 years ago, specifically a specialized agricultural lender that is trying to address the missing middle of rural finance. That is, businesses that might aggregate several hundred or a few thousand small-scale farmers, but that are too big for microfinance, and at the same time they're too small, they're too risky, they're too remote for the banks. Mm-hmm. And so we do three things, really, and it's been an evolving strategy, but it's finance, advise, catalyze. We provide capital to those agricultural businesses, and our model is around agricultural value chain finance, where we're lending into value chains. Often,
so processing, distribution, those types of things?
Yeah, and so if you have Whole Foods who's buying dried mangoes from West Africa, often in the absence of the hard assets that the bank would look for, we're lending against purchase orders or forward contracts, revenue, bankable revenue. Mm-hmm. So there's the lending piece to businesses locked out of the banking system for lack of traditional collateral. Their remote location, their lack of financial sophistication. The second is financial advisory services. So we build local capacity through financial management training. So folks that have little to no formal business training, i.e. the management team of a farmer co-op, for instance, can better compete in global markets. And the third one is trying to catalyze an industry. So how do we crowd in competition by encouraging others to recognize market opportunities in the countryside, especially local banks, maybe microfinancial institutions moving up, and thus our vision of kind of a thriving financial market that in a permanent way serves these small and growing businesses that generate long-term social, economic, environmental sustainability.
Okay, yeah, no, I think that's interesting, and I know most of the viewers would be familiar with micro lending to micro entrepreneurs, but you're actually in a somewhat different market segment. So some of the farmers who benefit might be micro farmers, but you're not lending directly to them, right? Can you explain the difference a bit between micro lending and what Root does?
Yeah, so I think the key, almost everything that we do starts from the conviction that small and growing businesses, in particular agricultural businesses, can really be an engine for driving economic growth and job creation and environmental sustainability in these emerging developing countries. So if you're an atomized individual farmer that lives 2 days away from the nearest city in the Ivory Coast as a cocoa farmer, you are not going to be competitive as a standalone producer. But what's exciting about a small and growing business that might aggregate hundreds or even thousands of the small-scale farmers is they do several things. One is that they create attractive markets or access to attractive markets for smallholders' produce. So on the one hand, that might be tapping into global markets for high-value, sustainable, natural products.
So like they're a contact point for Starbucks to source, and Starbucks doesn't have to find all these small coffee producers.
Exactly.
Or Whole Foods or something, right?
They're aggregating, and by rolling up that production and achieving economies of scale, investing in infrastructure, they're able to leapfrog the local middlemen and sell into a much higher value product. Increasingly, we see also, and in our own work, that it's not just the global value chains, it's not just the Marks and Spencers and the Starbucks and the Green Mountain Coffee Roasters, but it's selling into local supply chains for staple food products, where it's maybe local supermarket chains or micronutrient-enriched millet flour, and small-scale millet farmers are selling into that higher value. So that's the first. And the second one is these businesses lower vulnerability of small-scale producers to price and demand shocks. So they're able to have a long-term trading partnership between the individual micro farmers and the enterprise that is in turn negotiating and selling to that market. The third one, which is really important, which you wouldn't find in kind of a micro entrepreneurial context, is the small and growing business allows access to agronomic training and value-added inputs like better seed and helping them on being more productive and higher quality and so on. And often the government used to do that through extension services. A lot of that doesn't happen, or if it's done very poorly. And now you see a lot of these agricultural businesses and the supply chain itself investing in that training for the farmers to make them more competitive. And the last one, which is very interesting, I was just last week in Burkina Faso, and we were visiting a mango exporting company that aggregates about 2,000 small-scale mango farmers. And the mango associations, 11 of them that then sell up through this exporter, have invested in maternity wards, new deep water wells with water distribution systems around the wells. And they're taking their own hard-earned income to invest in effect in community infrastructure. And as these anchor institutions in the countryside, i.e. a small and growing business, they're able to, in some respects, do what the municipality or the state should be doing, investing in public goods.
But they've walked away, or they just don't have the
They've
government doesn't have the competency to
rolled
do it,
back
right?
the state frontiers maybe years ago.
Right. Okay. So, well, you've mentioned a couple of interesting companies, but can you just give us a sense of kind of the size, the amount of lending of Root, and what countries you're in? I mean, so Root has grown to be quite a significant organization.
Well, I'd say we're still pretty insignificant in terms of the need, but we've been growing rapidly the last 3 or 4 years, about close to 50% CAGR for year-on-year growth over 4 years. And last year, we dispersed about $115 million in credit to about 240 businesses. 80% of that in Latin America and 20% in Africa. We're operating in about 30 countries.
Okay, and Africa is a newer initiative for
Africa. We've been working in about 2005. So we're in East Africa, countries like Rwanda, Uganda, Tanzania, Kenya, Malawi, Zambia. And then in West Africa, in Francophone West Africa and Anglophone West Africa. So that would be, for instance, Burkina Faso, Mali, Senegal, Ghana, Liberia. We have a lending capital pool of about $70 million now. Of that, roughly $60 million is debt. So we're paying a whopping 2.5% coupon to about 100 impact investors who see it as kind of a...
Okay, this is on your capital side. The resource is available to you, right? Okay.
That's right. Resource available to us.
So
We
60 million of debt.
60 million of debt that we raise from about 100 investors, pay them a 2.5% coupon. We have about a 99% repayment rate cumulatively.
From the people who borrowed from you.
From the people who borrowed from
Right.
us, and 100% repayment rate to our investors.
Right.
We also raise philanthropy to pay for operating deficits on our sustainable trade fund, which is our core lending business. Last year we covered about 82% of our fully loaded operating budget on the lending with interest and fees on the portfolio. So we're not break even yet.
Okay.
But
You're
we're getting,
covering 80% of your costs from
we're
the
getting very
business,
close.
Right.
So we have a loan portfolio that is the export crops and markets, sustainable natural products, and then we have a much newer portfolio, which is our innovation portfolio, which is mostly focused on food security and nutrition. So that's those local food and agricultural systems. That's about $4 million we've raised from folks like Gates, General Mills, interestingly, Rockefeller, others, where we're piloting with a softer pool of capital loans in a new market for us.
And the idea is it's more experimental. Like you don't know if these are going to be profitable or not. You're kind of testing and creating new markets or new products.
That's right. I mean, we see ourselves as a catalyst agent, if you will, for the financial services industry, where we say, okay, we have actually built up a pretty interesting core competency in agricultural value chain finance, lending into these value chains. But we initially did that in the maybe easier export market dynamics, where we have a dollarized or a euro or a pound sterling based offtake agreement with Whole Foods, and that's how we make sure we get paid back. We're now saying, let's take that core competency and move into adjacent markets where it's still about understanding how product converts into cash, converts into repayment capacity, but maybe the revenue stream is by selling hybrid, high yielding, drought resistant seed to a network of agro dealerships deep in the countryside versus exporting to Whole Foods. So it's a softer pool of capital, and it reflects, I'd say, 2 strands of DNA of our organization as a kind of a non-bank financial institution. One is scale and demonstrate, i.e. our sustainable trade fund. Scale that achieve financial sustainability, have a demonstration effect that really crowds in competition because the banks or others say, wow, why wasn't I doing that?
Right.
The other strand of DNA is to push the frontier. Push the frontier of rural finance where others have yet to tread. And for us, that is, for instance, getting into food security and nutrition.
The local markets.
Yeah,
right?
so we're not getting crazy. We're not equity investors. We're maybe not smart enough to do that, but we really do understand cash flow lending. And yet we don't want to be naive about that is riskier. We don't want to erode the quality of our core lending.
Right.
So we have to kind of firewall it and create the right kind of capital that is willing to take those kinds of risks and kind of go on that journey with us.
Right, and that's more philanthropic capital, not.
Yeah, in this case, it's 50-50. It's
Right,
50% philanthropic, it's 50% senior debt.
Right. But they understand that it's higher risk.
Yeah, they understand that we're in the high risk, low return sweet spot of agricultural finance, and they're willing to bet on us as a team to figure out how to do what really very few have figured out how to do.
Can you take just a minute or two and explain, like on your core business where you're financing exports, that you have this 99% repayment rate, but why is that relatively low risk for you? I mean, you have a fairly kind of clever way to make sure you get paid back, but we haven't dived into that, so maybe you can explain it for the viewers.
So first thing I'll say is no matter how good our risk management strategy is, the markets we're working in are kind of nosebleed risk section lending arena. A lot of things can happen between the farm gate and the port in the mango sector. For instance, just last year, anecdotally, a business we're financing that is exporting mangoes relied on a 36-hour cold chain, train to get their product to Abidjan in Ivory Coast.
Refrigerated the whole way, right?
Refrigerated the whole way. Everything predicated on getting there in 36 hours in a sophisticated port where they can get that to Western Europe. Well, when lead started to fly last spring in the Ivory Coast, that whole transportation system shut down. So this business, to whom we had loaned $500,000, looked all across Burkina Faso to find refrigerated trucks. As a landlocked country, there wasn't one refrigerated truck. They had to go to Morocco to get them to bring refrigerated trucks there. Right. So a lot of things can happen in terms of taking...
So you started with risk gone bad. I was hoping to explain why it wasn't risky.
No, but I'm saying, so there are those challenges, but here's why it's a compelling way to manage your risk in agricultural lending, which is you can in effect... we understand everything that can go wrong in the mango value chain, and really the real risk we're taking on is performance on the contract. As long as the product gets to the port through an assignment of receivables, when that product ships to Marks and Spencer's, then we then get paid back by the buyer for the value of the product as the lender. We discount the principal and interest owned to us for the cash that we fronted to that farmer cooperative, for instance, and then remit the rest to the borrower.
Right.
So that triangulated loan repayment, which has been, that's a very common way. Receivables financing, factoring or pre-factoring is very common in the industrialized kind of markets. But in developing countries, they're not doing this. Just basic cash flow, receivables financing isn't happening. So I think this is typical of many social enterprises. It's not necessarily some big new innovation that's going to address these kind of deep-seated market failures. It's actually cobbling together old ideas and then executing on them extremely well and efficiently and being able to kind of address a lot of problems.
Right, and you probably have to do some adaptation to the new market and everything, but it's an old idea just brought into a new environment.
That's right. I would say our core company, our most important expertise is being able to hire local talent who understand these agricultural businesses and supply chains, who have a banking background. Sometimes they come out of microfinance. Sometimes they come out of the finance function of an agricultural business, but often they're coming from commercial banking. And deep industry expertise, high-touch relationships, and strong credit underwriting talent and systems and processes that we bring to them are kind of the secret to doing it well.
Okay. And I'm going back a bit, but you said you had several 150 or so loans. What's your average loan size?
So average loan size is actually $350,000 or so.
Okay.
However, the median is about $180,000, and that's important to highlight because our strategy is really as follows: we want to, we are focused on small-scale farmers. Our conviction is those small and growing businesses are the economic engine that will drive prosperity in the countryside. And our greatest impact, we have realized, is when we get to those rural businesses when they're relatively early stage, poised for significant growth, but for lack of access to capital and financial training. So we start with a starter loan of, say, $100, $150, $200,000, and then we accompany over a 3-5 year period the growth of those businesses. Often is exponential, the growth.
Right.
Because they're only bringing in 20% of the crop of the farmers because they can't pay them cash on the barrel held, at the moment of truth when they deliver to the warehouse. So we accompany that growth, but when we start, it is really a loss leader loan. We don't cover all our costs on that $100,000 loan to a business that's 7 hours from Bamako in Mali. But when they grow up to $500,000 or $1 million or more loan, then those are sustainable to serve. So our average loan size is significantly bigger than the starter loan size or the median loan size. And to me, that's critical to, and I think it hits upon a central theme around social enterprise. How do you scale your innovation and achieve sustainability without going upmarket at the cost of the original market gap that you identified? And for us, this is the way to do it, to have almost a cross-subsidization by accompanying those early stage businesses through their growth, celebrate when they graduate to other sources of capital and banks and so on. But in effect, when they get bigger, they allow us to continue in perpetuity financing the most missing of the missing middle. Those smaller businesses that are just ready for game day, but nobody's going to touch them. They're proto-enterprises unless root capital gets to them.
Okay. That's great. So this is, I know you, I'm shifting gears a little bit here, but so you went to Yale, went to LSE, and then you were kind of on an investment banking track for a while, right? And how did you end up in this space?
So
there's a lot of interest in social enterprise careers among our viewers.
So I was working on Wall Street at Lehman Brothers in Latin American corporate finance, and I hit it at an exciting time, kind of the emerging markets boom, in the first half of the 90s. And yet I had worked actually right out of college as a journalist in Argentina and Brazil. I had a lot of interest in the journalism side, and I won this wonderful business journalism fellowship in the mid to late 90s that took my wife and to me, and she was working on Wall Street as well, on a 2-year journey to Mexico. And living in the south of Mexico in particular, where we now have an office and do a lot of work, I really was able to witness rural poverty in many villages and started to really understand the economic drivers of things like deforestation and immigration and drug trafficking. And I also kind of had the privilege of meeting many, many leaders, super charismatic leaders in the countryside, more often than not, who were running agricultural businesses, like a farmer cooperative. And they had a big impact on me. They were poise, sense of purpose, leadership skills that you might find in a CEO or a congressman. But they were running these agricultural businesses that often had hundreds, sometimes thousands of coffee farmers, and they'd get stuck. And my wife was actually working at the time in Mexico for Acción International in microfinance. They would get stuck in what I didn't know how to name it at the time, but this missing middle, this big yawning void between microfinance and where the banks are willing to finance them. So
they'd take out Acción loans, they'd grow a little bit, and then they'd outgrow Acción, and there'd be nobody next.
And it's kind of a false premise that there's this natural graduation of a micro-entrepreneur to kind of a necessity entrepreneur to a large and growing business that has infrastructure and so anyway, I started thinking about how might one change that outcome. Businesses failing for lack of 3 crucial things: financial capital, qualified employees, and sufficient market access and knowledge. And so I said, okay, how might one change that? About the time that we were about halfway through this 2-year fellowship, I was admitted into the Harvard Business School, as was my wife. It was kind of an elegant exit strategy from this journalism fellowship. And many months later, we got in our truck, started driving to Boston, and I had this growing fear along the way that if I didn't act on my ideas around how to fill that missing middle, how to come up with a way to finance these agricultural businesses, that I would lose my sense of urgency. I'd never act. So I ditched business school. My wife went. We had a kid right out of after her graduation. We'd set up shop in Boston. I'd launched Root Capital, and I've been doing that ever since.
Okay, that's great. So seizing the moment, right?
Right.
And I guess my last topic is I know that the last thing I wanted to ask about is so Root is very much explicitly a social business, and so you have I don't know if you would call it concessionary capital, but relatively low cost debt, and you have some grants. And so I'm interested in how Root thinks about measuring social metrics. I mean, it's relatively easy to measure your financial metrics. What's your repayment rate? What's your lending margin? But you think a lot about social metrics as well, or your impact. Can you just talk a bit about how Root thinks about that?
Yeah, it's a tough topic, and we do think a lot about it. We think a lot about it in kind of at the industry level as well. That our peer institutions can we all subject ourselves to the same standards and the same metrics and so on. In our case, I guess the first thing I'd say is there are kind of three levels. One is the outputs from the factory gate, which for us is capital and training. Those are the outputs of our institution. The outcomes of those outputs are really the growth of the enterprise and kind of what's happening at the enterprise level. And we track those metrics very carefully. So what's the year-on-year growth revenue? Most importantly, what is the year-on-year payout to farmers in the cost of goods? What do they pay to the farmers? And then you have to do some deeper dive studies. But what's the delta between what a farmer might get paid for his or her cocoa at farm gate versus to the enterprise?
Right.
So there's a lot of work we do on what we call social value metrics across the entire portfolio that are enterprise level metrics, which are really measuring the outcomes from those outputs that come from us.
But you're measuring the outcomes both to the organizations you're lending to, but then also to the various farmers they're sourcing
And
from.
kind of from the enterprise level metrics, trying to extrapolate what's the impact at the farmer level and the household level. And I'll come back to that in a second. In terms of the enterprise level metrics, so just taking our 5-year business plan, our strategic plan, we will count the beans very carefully. We expect to be financing 550 businesses in year 5 of our plan, 2016, which will aggregate 700,000 smallholder producers, which if you count family members will be about 4 million people for our sustainable trade fund. And so we can from there talk about what are the revenues, what's the payout to farmers, etc. The most difficult but maybe the most important piece is the third kind of bucket, which is impact. And we look at that at kind of 3 levels. One is at the household level. And most importantly, what's the income, the increase in income for the farmers themselves? The next one would be at the community level, which would be, are they investing in maternity wards or in schools or clinics? What's the environmental impact in terms of kind of the landscape mosaic and the agroforestry system? And then there's kind of the regional / markets level. What kind of capital is being mobilized into the space? What type of ripple effect at the regional level in terms of employment and looking at the backward and forward linkages? As you might gather, that's a much stickier wicket in terms of a cost-effective way. How do you measure that? And so what we're basically looking at is kind of a mixed method where we do medium deep dives on a sample basis, a representative sample of our portfolio. For instance, we just did one this fall in Burkina Faso on a mango exporter. We do a lot of mango financing for smallholders in West Africa and in Latin America. We say, okay, let's send in an economics professor from University of Illinois in Champaign who's from Burkina Faso. And with a team of students, look at economic, ethnographic, and anthropological issues around what's the impact, without a randomized trial per se, what's the impact of this economic activity on the 11 underlying farmer associations that aggregate about 2,000 mango producers. Where have they chosen to invest their discretionary income in community-defined priorities like maternity wards? On a sample basis, how much additional cash are those farmers getting by selling that fair trade organic mango, into European markets, et cetera? So how much money can one justify as a financial institution on those deeper dive studies is an open question, but we're trying to do enough to keep the impact investing kind of industry, our donors and others satisfied that we're not flying blind. But at the same time, I believe that would be a misallocation of scarce resources as we're still subscale as an organization, not break even on our core lending, to spend too much money on that, but we have to be very focused on it. I think we saw in the case of the microfinance industry that there was maybe a lack of keeping impact measurement and a focus on how to understand that in step with the growth of the industry, and it came back to haunt the microfinance industry around over indebtedness and what happened in Andhra Pradesh.
Right.
We want to avoid that, so we're focused on it, but we're trying to be very realistic and managing expectations with donors and investors as to how much we can justify doing.
Like root capital is not going to solve the problem, and I know by itself. I mean, you can do the stuff for your investors, and I think there's some efforts at the kind of sector level or the industry level through the Aspen Institute and others, right?
One last thing I'll mention,
Sure.
which is I think maybe it's the most replicable, the most important piece of the metrics and kind of impact side of our lending. Where yes, we want to catalyze a thriving financial market for these agricultural businesses, but we really want to set the standards in terms of the social and environmental practices that we want to see, our values we want to see embedded in that market. And so we've done a lot of work on what we call our obligor scorecards, which is we have a financial obligor scorecard, which is kind of really hardwiring and systematizing how we think about credit underwriting and what are the risks. And so that's something that any new loan officer can quickly be onboarded and up to speed on how we think about risk management in the cocoa sector. We also have an environmental and a social obligor scorecard. So in other words, crap in, crap out. How do we provide a very efficient way for a loan officer, and it could be somebody for city, and it could be Root Capital coming in and looking at the shea butter industry in West Africa and understand really how do we understand whether this is an environmentally responsible agricultural production system, and hardwiring that, and on the social obligor scorecard as well, hardwiring that could be one of the most important contributions we make to the financial services industry, because they can take those tools and apply them to their own credit underwriting systems and processes.
Good. Well, that's a lot to think about. Root's a very interesting organization, and I'm happy you came to visit us in Ann Arbor. Thanks, Willy.
Pleasure to be here. Thanks.